In this new video series, go behind the scenes of our prop firm, which houses numerous elite 7- and 8-figure traders, to learn our techniques and processes for producing robust, high-accuracy options trading strategies. In this case, a powerful option strategy with an 85% win rate. Hi, I'm Mike Bellafiore, co-founder of SMB Capital, a proprietary trading firm located in Midtown Manhattan, and I'm also the author of the trading classic, One Good Trade, in the Playbook. In part 2 of this video series, learn a key trading principle, researching new strategies that has helped our traders thrive, and how that drove the development of this new and powerful option strategy for you. Let's get to work on sharing this important trading principle and trading strategy so that you can grow your trading account. One of my favorite traders at our firm, we knew could be better. This is a trader everyone would root for, just a terrific all-around person. And he wanted badly to be as good as our best traders, but he just wasn't. Not yet, not yet, not yet. We knew he could be a green shirt trader. To be a green shirt trader at our firm, you need to make $1 million in net trading profits in a year. He was a solid inefficiency trader, making in the low 6 figures a year at the time. Whenever we spoke about his trading, I told him he could be better, that he should be better, and that he should believe he could be the next green shirt trader at the firm. Every time he would pass my office, I'd put that idea in his head. One suggestion on how he could do this was to do more price action trading. Said another way, that he should expand his playbook. Said even better, that he must expand his playbook. He was a pretty good price action trader, but he wasn't sure if this was for him and he hadn't fully committed to it. But he gave it a try. He gave expanding his playbook a try. He did some more price action trading, collaborated with other price action traders, and then ran into a market that richly rewarded price action trading. And he became the next green shirt trader at a firm. In fact, he became even better than a green shirt trader. He became a black shirt trader at our firm, which is when you make more than $2 million in net trading profits for the year. Now, he's one of the top traders at our firm. Now, he's setting goals to become an 8-figure-a-year trader. Now, he runs a team. He runs the very best team at the firm, where everyone on his team is at worst a consistently profitable trader. And this is all because he expanded his playbook. Our culture at SMB Capital encourages traders to research and experiment, to expand their playbook. It's part of what makes SMB a Tier 1 prop firm with elite 7- and 8-figure-a-year producers who continue to improve year over year. In this video, we're teaching you an important principle of our trading culture. Now, Seth, I know working to expand your playbook is very important to you. And Seth, how has the options desk sought to expand and add to their playbook?
Well, Mike, we're always researching new strategies. It's just culturally our nature. And in fact, we have a Options Tribe trading team of 50 traders who get together sharing new strategies with each other each week. And so it's just culturally part of what options income traders do. They're always seeking edges. They're always seeking new opportunities and new strategies. And so we knew from the beginning that we had an edge. And an edge that would be made much, much more powerful if we were able to find a daily signal that would indicate whether there was a higher probability than usual of the market either going up or going down in a particular trading day. And so we knew we had this edge because we trade index options very, very commonly on the options desk here at SMB. We knew for years that we had an edge involving the way we traded index options, but in order to complete that edge and make it powerful, we needed a one-day daily signal, and we just couldn't find one. So in order to explain why we thought we had an edge, we need to explain first how index options work, because they're not intuitively understood by a lot of people. So let's get into the basics of index options. The best way to think of an index option is that it is a bet. A call option specifically is a particular kind of bet. It's a bet that pays off if the market closes above the strike price of the option on the day the option expires. And the one who buys that option, that call, is paying a premium to the one who's selling that option. The one who's selling it, the call seller, is the one taking the bet and receives the premium. If the index closes above the strike price, the seller pays the buyer $100 per point that the index closes above the call's strike price. So it's a bet that pays off $100 a point above the strike price of the call. Now, a put option, on the other hand, is a bet that pays off if the market closes below the strike price of that put option on the day the option expires. The put buyer pays a premium, just like the call buyer does, and the put seller is the one taking that bet and receiving that premium. If the index closes below the strike price, the seller pays the buyer $100 per point that the index closes below the put's strike price. So the call option pays off when the market closes above the strike price of the call, and the put option pays off when the market closes below the put option's strike price. So let's take an example just to make sure you're clear on this. Let's say you've bought a 4,000 call, and the market has closed at 40.32. Okay? Well, in that case, then, you would take the market closing price, 4,032. You subtract the call's price, the call's strike price from that. That comes to 32. You multiply that by $100 per point, and it would pay off an amount of $3,200. But suppose you owned the 40.75 call and the index closed at 40.32. Well, that one expires worthless, and the call seller, the person you sold that option to, that person gets to keep that premium. That's theirs, and you end up as the call buyer with nothing. That's an important principle to understand as we move on here. Let's take an example of a put. Let's say again the index closes at 40.32, and you own the 40.75 put. Well, that put, because the market's closed below 40.75, that's going to pay off $43 43 points below the put strike price times $100 gets you $4,300 in a payoff off of that put. But if you had owned the 4,000 put, that one is going to expire worthless, and the one who sold that put to you, he gets to pocket that premium. Those are the simple basics of index options. Why were we seeking a reliable one-day directional signal? And the answer is because we know about a strategy called the credit spread. I want to give you some examples of how the credit spread works so you're going to understand why we get so excited when we think about finding a directional signal and marrying it with credit spreads. Let's say an index is trading at 3,000 and you want to be bullish. Okay? Well, let's say it's a Wednesday and these options expire at 4 p.m. So if you sell the 29.90 put for $35 and you buy the 29.80 put for $31, that combination is called a put credit spread. You're short the put that is above the long put, that's a put credit spread. Now, what's going on here cash flow wise? Well, you received $35 for selling that 29.90 put, right? You multiply that by 100 because your payoff's $100 a point, and you receive $3,500 in cash. But you then turn around and pay out $3,100 of those $3,500 because you're buying that long put at 29.80. We'll explain later why we're buying that long put, but for now, just accept that a put credit spread is a combination of a short put closer to the market opening and a long put farther from the market opening. And the net cash you would have received in this example, as you can see from the calculation, is $400. We understand that most retail traders don't have the time, expertise, and resources to develop a sophisticated, mathematically accurate system to determine the likely direction of the market each day. And so SMB has taken care of that for you. We've developed a highly profitable trading system based on a robust trading signal that can easily be implemented by traders of any experience level in just minutes a day. If you're interested in learning more about exactly how that system works, go ahead and click the link that should be appearing now at the top right corner of your screen. That will open the free workshop registration page in a new window, so don't worry, you won't lose this video. I think you'll be pretty intrigued by what we've developed for you, so pause this video, sign up now, and then resume watching. Let's say we're off to the races now with our trade, and the market closes at 30.35. Okay? Well, we've got that 29.90 put that we sold, and we also have bought that 29.80 put. But both of those options expired worthless. Why? Because the market closed above the puts, and the puts only pay off if the market closes below them. So they expire with no value, and the $400 you got at the beginning of the day for selling that put credit spread, you get to keep that. Okay? So if the market rallies strongly, you win this trade 100%. You have a full win of $400. What if the market just goes up a little bit to 3,002? In that case, again, you received the full $400. Why? The market's closed above both of the strike prices of those put options. They both expire worthless. You just keep your $400. What if the market doesn't move? Miraculous day, no movement at all in the market, right? You get $400. Why? Because both the 29.90 and the 29.80 puts expire worthless. What if the market goes down to 29.88? It drops to 2 points below the short put that you sold, okay? Well, now something has to happen, and that is that short put is going to pay the guy who bought it from you $200. Why? Because the market's closed at 29.88. Your short put's at 29.90. That's 2 points lower than that option strike price. You multiply that by 100, and you have to pay that guy $200. Whereas the 29.80 put that you bought, that one expires worthless because the market closed above 29.80. Nonetheless, you win that trade. Why? Because you got that $400 originally, you paid out $200 on the 29.90 put, that leaves you with $200. So even though you did a bullish trade, you still won, even though the market went down. Now, let's take a look at the case where the market closed down a lot to 29.70. Well, now you got a problem because now the 29.90 put pays off $2,000 because it's closed 20 points below that strike price. But that 29.80 put that you bought, you're actually going to receive $1,000 for that. So to calculate the outcome of this trade, you take that original $400 credit, you subtract out the $2,000 you paid out on the 29.90, you add back in the $1,000 you received from that 29.80, and as a result, you lose $600. So what does this mean? Let's say you've got a bullish signal on an index. Well, it can only be right in two different ways. If the market goes up a lot or the market goes up a little. It's therefore wrong if the market's flat. It wasn't bullish, so it's wrong. If the market goes down a little bit, it's wrong. If the market goes down a lot, it's wrong. So, in 3 out of the 5 cases, a bullish signal will be wrong. If the index goes up a lot, the signal's right. If the index goes up a little, the signal's right. If the index is flat, the signal's wrong. If the index down a little bit, the signal's wrong. And if the index goes down a lot, the signal's wrong. But a put credit spread wins in 4 out of 5 cases. If the index goes up a lot, you win. If it goes up a little, you win. If it doesn't move at all, you win. If it goes down a little, you win. Only if it goes down a lot. In other words, if the signal's terribly wrong, then of course you lose. We knew we could improve the win rate of any signal by using credit spreads. We knew that. That was a fact. And therefore, we need to go find one. Something else happened in the options market in late 2017, early 2018, and that is that Monday, Wednesday, and Friday, S&P 500, which are known as SPX index options, began to be promulgated by the options market. And so therefore, what does that mean? Monday, Wednesday, and Friday are 60% of all weekdays, right? So that means 60% of any daily signal that we could find, we could be traded and concluded in that one day. That was a very, very important development in the options market, because now it means if we can find a one-day signal, we can trade index options on those same signals, and those trades would end up and be concluded on that day. And that was a very important development for our options desk. But even if we were able to find a signal, we're going to have to test for the expectancy of the results of those trades. Why? Because you could have a very high win rate, but have losses that are so much larger than your wins that they wipe out all of the profit you got on those wins. So we had to make a determination as to whether there was actually a positive expectancy. We knew we could improve the win rate. There was no question about that. The question is whether, if we combined the right signal with put credit spreads, would we have a strongly positive expectancy? And finally, any test that we needed to do to determine the efficacy of any signal when applied with put and call credit spreads needed to have a strict set of rules so that the back tests could be completely objective and not in any way subject to any sort of subjectivity. Here is where the story begins to get exciting, because in March of 2020, I met this guy, Scott Andrews, from InvestiQuant. It was pretty much the exact day the world began to realize that this pandemic was for real, and that we were all about to go into a serious lockdown. And so the economic implications of this were massive. And on that day, Scott and I were at the Money Show here in New York, and we met each other in person for the first time. We ended up meeting back in the office later, and I said to him, you know, I've been running this desk for many years. We've been looking for a one-day signal that we can trade using SPX index options. Do you by any chance know of any good signals? And he said, well, as a matter of fact, we have one, and you should hear a lot more about it. He explained to me all the details he went into in terms of his development of the system, and it obviously sounded like something we needed to know a lot more about. So Scott sent me some output from the IQ Adaptive Ensemble signal, which we already knew at that point had an accuracy rate of 71%, which is astonishing to start with, all right? From our initial testing, we knew we could get his win rate up from 71 to 85%. So we got very excited, but we had a lot of work to do, because even though we knew we were going to be winning 8.5 times out of 10, which is absolutely astonishing, as any of you who are trading can attest to, nonetheless, we needed to see what kind of expectancy that this would produce. That was a different question, and one we needed to spend a lot of time answering.
And Seth, just so the people who have less trading experience than the two of you get this right. So basically what you're saying is you took your trade with edge and you combined it with Scott's signal with lots of edge. You put them together, and that is what improved the win rate from 71% to 85%. That's what created an even better trade for you.
Exactly. Because
so
otherwise
it made your trade better,
yeah.
It made his signal better, and everybody won.
That's right. Otherwise, you're flying blind. You slap a bullish trade on having no idea if the market's going to rally or not. And without that additional edge of knowing that you have the historical edge in your favor on a particular trading day, you can't feel good about your trade. Even though we knew we had a high win rate, we didn't know that we had a high expectancy.
And if I may add, even though we had a super high win rate strategy, trading futures, we're futures traders back in our shop, it was difficult to monetize it because we had unlimited losses trading long or short in futures, where you could cap the losses and control them with a credit spread.
Exactly. And the credit spread caps the losses, as we'll be getting into as we proceed in this series. Now, in our next video, we're going to be reviewing exactly how we combine the IQ signal and options credit spreads and how incredibly that worked out. By combining the IQ signal and the powerful options credit spread strategy, we knew we had something, and we were very excited about that. So as I mentioned earlier, regardless of the type of trader you are and your experience level, you can utilize our system to augment your main trading activities because the IQ signal only occurs 2 to 3 times a month on average and can be executed in under a minute the few times per month that you do receive a signal. We'd encourage you to attend the webinar where we can offer you this system at a huge discount. So just go ahead, click the link that should be appearing now at the top right corner of your screen. That will open the free workshop registration page in the new window. I think you're going to be pretty intrigued by what we've developed for you. So sign up now to arm yourself with this powerful trading signal before it's too late.